and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to direct that hard look at the ongoing crisis in NBFCs, non-banking financial companies. Andy Mukherjee, the Bloomberg journalist, writing in Mint of 6th May this year, says the trouble brewing in India's shadow banking world is the most scary of the country's problems because it threatens to engulf and boomerang on both the ultimate users of the funds, that is essentially construction companies, and their original providers, that is banks and mutual funds. Is Andy only being a typical journalist given to hype without justification, or are his fears warranted? To discuss that and much more, I have with me an excellent panel of experts. The straight-talking Hemendra Hazari, who keeps a keen eye on the financial sector and never minces words. Satyan David, former Chief General Manager, Reserve Bank of India, Department of Non-Banking Supervision, who now that he is retired will tell us whether the regulator was in fact caught napping, and if yes, why. And Rupa Nitsure-Rege, formerly with Bank of Baroda and now with an NBFC, L&T Financial Services, who's best placed to tell us what is it that makes NBFCs so like banks and yet distinct from them. Welcome to the show, Hemendra, Satyan, Rupa. The crisis is over but problems remain was how Aditya Puri, HDFC Bank chairman, put it recently. Let me start by asking each of you in turn, can we say with any degree of confidence that the present crisis is over, or is it still smouldering? And was this a crisis that was really waiting to happen? We'll get into the details later, but for now I just want a very brief opening comment. Let me start with you, Hemendra.
Essentially, the problem that we have in the NBFCs is really the problem with the underlying economy. And that is the way it has to be recognized, not just a problem with the NBFC sector. Because since the Lehman slowdown, the government responded by compelling banks to lend to infrastructure companies as to boost the economy. Now, when that played out and you had all the NPAs surfacing in the construction, real estate, the banks withdrew from the sector. But however, NBFC started, lending to these sectors, and the banks in turn lent to the NBFC. So in effect, the banks took an indirect exposure to all the real estate, construction, and all these high-risk areas which they had directly, were exposed to earlier. Now, as a result of which, today you're finding that, it has been handed over from the banks to the NBFCs. And the problem still very much remains, which is the underlying economy. And it is not just a problem of liquidity in the NBFC sector.
Okay, so the problem still remains is your view. Satyan, you are now on the other side, advising two NBFCs. And so you have an inside and a ringside view of what is happening in the NBFC space. Would you concur with Hemendra that it's basically, the problem with the economy? Or is this the tip of the iceberg and related only to NBFCs, Satyan?
So to give a bit of background, see, the market combines NBFCs and HFCs as one sector. So the NBFC sector by itself is quite diversified. So there are a number of NBFCs, they finance retail, they finance MSMEs, and to some extent they finance real estate activities also. The other segment is housing finance companies who are more into real estate and residential mortgages. So their concentration risks are a bit higher than normal NBFCs who are well diversified. And NBFCs have there are two, comments going on in the market I'd like to clarify. It's not that NBFCs and HFCs have tanked up on CPs disproportionate to the total liabilities. If you see the data in the trend and progress of banking report released by RBI in December, as on September and as on last year, CPs as a percentage of total liabilities of NBFCs were steady at 6.8% or so, and the large percentage was taken up by bank borrowings. So the NBFCs being largely diversified, as Hemendra said, this seems to be more of a problem with the underlying economy and a scare factor spreading through the economy. So these are the NBFCs and HFCs are fairly well regulated. NBFCs have a CRAR of 15%. And even the ALM norms are more or less in alignment with banking. Only the reporting structure is slightly more infrequent. The NBFCs report at quarterly intervals, banks report at monthly intervals. And NPA norms have been brought in harmony with banks.
Satyan is trying to defend his past employer, but Rupa, as Group Chief Economist at L&T Financial Holdings, what is your assessment? And I'm not asking you about L&T Finance at all, but I'm asking you about the NBFC sector in general. Is the crisis over, or is there a continuing crisis that we are ignoring at our peril? Rupa.
I agree with both the co-panelists. First of all, as Hemendra ji said, the problem is more with the real sector. And currently it looks a bit ugly because of confluence of various factors like uncertainty created by elections and global headwinds, etc. Having said that, I would say that compared to September-October 2018 situation is has improved considerably now because of the prompt corrective actions by RBI. I mean, the liquidity flows have improved considerably. Banks that time were borrowing more than rupees 1 trillion. Today, borrowing through repo window has also come down to 500 billion. And flows have improved to NBFCs. What is concerning is that this favorable development in terms of liquidity or benign trajectory of inflation, it is not getting reflected in their cost of borrowings. And I think that has more to do with the trust deficit rather than any liquidity crunch.
Well, all three of you seem to think that the problem really is with the economy, but the economy we think is growing at 7%, regardless of the controversy about GDP. It certainly is growing at around 7%, which is not a bad rate of growth at all. And Hemendra, one of the key learnings of the global financial crisis really was that the financial sector does not function in silos. Problems in shadow banks can and do spill over to the rest of the financial sector, especially banks, and with possible disastrous consequences. Yet we in India seem to have ignored this fundamental lesson. The rapid growth of NBFCs at a time when both bank credit and the economy were slowing in the past didn't set off any alarm signals when they should. Why?
Because everyone has compromised interest, that is in a nutshell. What were the analyst community, the highly experienced, highly overpaid analysts doing? They were in fact praising all these NBFCs. They were saying they are going to take over the banking sector. The banking sector, the government banks have withdrawn, and therefore, these are the new darlings on the stock market. Their valuation soared. And in fact, they should have been questioning who these entities that the NBFCs were financing. These were all the high-risk entities which the banks had withdrawn from. Unfortunately, the banks, they withdrew from the sectors but continued to lend to the NBFCs thinking that they are safe. And the problem really is not a liquidity problem. Again, let me emphasize this. I would also like to remind your viewers that when ILFS first arose, the problem, everyone said it's a liquidity problem. It is really, as in ILFS, a solvency problem, because the underlying borrowers who have taken funds from the NBFC sector are sitting on huge hidden losses in real estate, in construction. So these are real losses. And I think we would be fooling ourselves to believe that this is merely a liquidity problem that the NBFC sector is facing. So even if you inject liquidity, it is not going to solve the problem, because now banks also realizing that there is a solvency problem with the NBFCs, and rightly now they have taken a decision that they will not lend to them.
Sure, Hemendra, spoken into Hemendra style, and I would agree with you. Now, Satya, let me toss the same question to you. You were in the Department of Non-Banking Supervision in the Reserve Bank of India during the phase of very rapid growth of NBFCs, especially, as you said, HFCs, Housing Finance Companies. NBFCs were taking risks that banks shied away from, even though the very same activity was being funded by banks. Was there any anxiety or even discussion in the Reserve Bank of India at all on what was driving the growth, whether the growth could be sustained, etc., since the RBI had already seen that a disproportionate rise in non-performing assets is the natural consequence of a very rapid growth in credit, and they'd seen that during the boom years? Satyan, so what really went on in the Reserve Bank of India? Were they all sleeping?
See, the Reserve Bank inspections and as you see, the growth in NBFCs took off because of the public sector overhang of NPAs in public sector banks and the problems with capital constraints in public sector banks, and a number of them being placed under PCA. So NBFCs took up the gap and started lending. And the economy in the last few years has been growing on the basis of consumption demand and real estate demand. So this is where NBFCs stepped in. And there was substantial growth, but see, the RBI's system of supervision is quite strong and rigorous. We have a system of supervisions. We identify companies who are growing fast, take them up for inspections, see what are the exposures, risk exposures, concentrate on those. And the fact is that outside doesn't know the actions we have taken where things have worked out satisfactorily. So these are aspects which are being seen, and we have a good database where we see where the growth is happening. So inspections have been done and actions have been taken on certain NBFCs which have managed to have a soft landing. It was only in the case of IL&FS, and where say, all inspection reports findings are conveyed to the management is supposed to act in a mature manner, appraise the board and work out a plan and see that the problems are resolved early. So in this case, the IL&FS twins were the financial entities. They were only a small part of the entire conglomerate, which is basically an EPC conglomerate. And IL&FS twins had only 30% or so of the total outstanding liabilities in the whole group. Other 34% liabilities to the banking sector and system is by ITNL. Now, if you see, the ITNL has a demand of 16,000 crores on various government agencies on whose behalf they are executing projects. This amount has not come in as required. So they went ahead and they had some short-term loans, CPs, which they defaulted on. And the upward payments, repayments to IL&FS, the parent who had lent to them, had also not happened in time. So the rating agencies got up and derated, I think, 6 or 8 notches downward at one stroke. So, and again, if you see the audit report, statutory audit report of IL&FS Financial Services for 2018, right at the end there's a comment by the auditor saying that the company has been following a pattern of classifying group companies as per definitions of Companies Act as approved by the board. There is a divergence between the company's definition and what RBI has identified as per its supervision. The regulator, the auditor and rating agencies have to work together and sensitize the management to the issues involved.
True. I think it is true that the Reserve Bank of India has done a lot perhaps, and we don't see the good work that is done. It's only the rotten eggs that always show up, but that is always part of the system. So Rupa, the IL&FS episode that Satyan also alluded to might have been the trigger for the present stress in the NBFC space. But would you agree that given the very nature of the model that we have in India, both contagion risk and stress are inevitable in the system, Rupa?
See, Mythili, first of all, I don't like the term shadow banking being used for Indian NBFCs, because they are not shadow banks. They are very tightly and granularly regulated by Reserve Bank of India. All systemically important NBFCs are very, very granularly regulated. I can tell this with authenticity because I have worked in all organizational forms, whether DFI or a bank, public sector, private sector, and now in NBFC. Having said that, I agree with Mr. Satyan that it's a very, very diversified sector. So you have HFCs, you have infrastructure finance companies, you have MFIs, and they have very different business models and they are working in different spaces. So today the problems in the real sector are primarily in the infrastructure space, whether you take telecom or aviation or power sector. So whether it is a bank, a corporate lending bank or a corporate lending NBFCs, they have suffered more stresses because of the problems in the real sector, because of the problems in infrastructure sectors. But same is not the case with other NBFCs. Moreover, NBFCs which have diversified business models, they actually can efficiently swap the credit risk and manage it better. So in today's context, what you have to look at is the actual business model of different NBFCs, how sustainable it is, their credit underwriting standards, their risk management architecture, and how they are taking care of provisions. Because today, whether it's an NBFC or a bank, we are all vulnerable to black swan events. So, NBFCs or banks, they should be prompted by the regulators to undertake, macroprudential provisions over and above the mandated provisions, because economic reality has become very, very uncertain. And you see, thanks to market surveillance, because I respect market surveillance as much as I respect regulatory surveillance, and information gathering capacity of markets is enormous. So I feel the level of transparency, the level of disclosures have improved significantly. If there is a need, regulators can insist on higher degree of disclosures or transparency. But putting all NBFCs into the same basket and creating some kind of panic for the sector is certainly not desirable.
Sure, Rupa and Satyan are entirely right that there are NBFCs and NBFCs, and it won't be fair to tar them with the same brush, all of them. Hemendra and I are likely inclined to be slightly less charitable, but we'll find out after the break. Please do stay with us. Welcome back. You're watching Macros with Mythili, and we're discussing the crisis in the NBFC sector with three experts: Hemendra, Satyan David, and Rupa Nitsure-Rege. Hemendra, the fact is that even though Rupa said that NBFCs are not shadow banks, the fact is that banks and NBFCs do much the same thing. Yet it is also true, as even David pointed out, that NBFCs are much less regulated. Example, they're allowed to engage in activities that are either prohibited or subject to strict controls in the case of banks, such as lending for real estate, trading in the stock market, etc. And while over the years RBI has tried to reduce the scope for regulatory arbitrage, its efforts have been mostly half-hearted. In fact, there are a number of NBFCs that were not found fit and proper by the RBI to get a bank license, but then they were allowed to free run as NBFCs. Why, Hemendra?
See, essentially this is the entities playing on regulatory arbitrage. For example, you have banks like HDFC Bank, which has a very prominent NBFC. The same with the Kotak Mahindra Group. Now, why should the Reserve Bank of India allow a bank to have another NBFC in its group? This is just to play on the regulatory arbitrage and to lower the cost of funding of the staff of the NBFCs. Now, the Reserve Bank of India should never have allowed such a situation to develop. In addition, what we have noticed in the mutual fund industry, in the NBFC, there's a complete absence or near absence of credit appraisal and credit monitoring. I mean, it's absolutely ludicrous when you see the kind of, the loans that they have sanctioned to some of these SL group companies, where they were all loss-making companies. They take a security of the main parent, which proves to be highly illiquid. So what kind of credit sanctioning, what kind of credit monitoring, what type of risk management was being done? This completely exposes this whole thing that, the market is the best, entity to manage risk. It's a complete failure of market mechanisms, complete failure of market supervision. And look at the case of ILFS. I mean, I had never looked at ILFS. I only started looking at it in September last year. I was horrified because if you look at the consolidated balance sheet, this company has been insolvent since FY 2014. So what was the market doing? They can't read. Are they so financially illiterate that they cannot see the importance of intangibles, which has to be by regulatory norms knocked off from capital? I mean, such a basic thing they could not understand. So this is what I find appalling, that nobody, this great idea that the market will decide best, it's a complete shocking failure of the market.
Okay, Satyan, Hemendra is absolutely scathing in his remarks, but it's not really as though the RBI was blind to the dangers posed by NBFCs. In fact, it had appointed a number of committees, most recently the committee under Usha Thorat, former DG. Yet many of the recommendations made by that committee remained on paper. Why? Also, you must distinguish between the HFCs and other NBFCs, but the fact is that HFCs were under the oversight of NHB, and it was 100% subsidiary of the RBI till very recently. So why did RBI turn a blind eye to what was happening over there, Satyan?
See, the RBI 100% ownership is more a technical matter of funding, either being from the government or from RBI. So RBI also has had ownership of IDPI earlier, which at divested, has ownership of NABARD. So RBI doesn't get into NHB is an independent regulator and a supervisor. So RBI doesn't get into operational issues. It only has a member on the board for overall policy issues. So as a professional regulator supervisor, NHB must be doing a professional job. So the other issues are regulatory recommendations of the Usha Thorold Committee, one was many of them have been implemented, like she had recommended stronger supervision of larger NBFCs with asset size 1,000 crore and over. So those are being done. There's a regular inspection manual had been prepared, and these large companies are supervised, inspected on an annual basis, and there's an offsite monitoring system on a quarterly basis. Now, if you notice, and there have been no real problems with large NBFCs. After ILFS was sort of the last domino in the infrastructure chain. The infrastructure financing itself has an inherent risk because of long gestation period projects being financed by relatively short-term bonds, because in India there is no long-term bond market available. So there has to be a relook into the pattern of financing infrastructure as a whole. After that, NBFCs, there have been no major crisis, all have sort of turned on and become more efficient. They have got, there was a lot of talk about huge amounts of CPs maturing by December 2018, which are all paid back. Then the rapid pace of growth has slackened. NBFCs have decided to consolidate. So the pace of growth over the December, at the end of December quarter and end of March quarter has been much slower than earlier trends. And then even the Credit Suisse report saying that a large number of CPs are coming up for redemption in March and June. See, what they are ignoring is the expected inflows. So if you net off expected inflows versus vis-a-vis the expected outflows, the net amount would not be substantially large. And even the end of September, banking sector advances growth to NBFCs was 51%, and even for December and March, banking lending to NBFCs has been relatively strong. And as the NBFC sector is very diversified. There are NBFCs promoted by large promoter groups who are quite safe. NBFCs are quite diversified. And and they have to also disclose their exposure to sensitive sectors like real estate, capital markets, commodity markets.
Okay, David, we'll take your word for it that the NBFC sector is largely healthy, but you're saying that the inflows will continue. I really wonder, because NBFCs seem to be running something like a Ponzi scheme, number one. Number two, I wonder what would happen if we attempted an AQR of NBFCs like we did in the case of banks. Which brings me to my next question, which is to you, Rupa. But at the end of the day, how much of the blame should we put at the doors of the rating agencies, and why do we give them such a long rope, Rupa?
If you look at only the stressed cases, then I think, we have to, everybody has to share the blame, whether it is auditors or rating agencies or, surveillance. But point is that you have to see that how proactively things have changed for the NBFC sector. Because whether you call it real sector crisis or ILFS, whatever, the governance crisis, post the ILFS debt defaults, it was a fact that liquidity was not available easily to NBFC sector. And then, what we describe in economics as the pro-cyclical responses by all stakeholders, whether regulators or rating agencies or auditors, they actually, such pro-cyclical movements actually tend to increase or accentuate the intensity of the crisis. But you should also see proactively what was the response of NBFC sector. RBI's own flow of funds matrix shows that even if, in FY18, the share of NBFC in total credit extended by financial intermediaries to real sector was as high as 22%. In FY19, it has come down to 1.5%. So you see, if anybody is saying that there was an irrational exuberance or the growth was excessive, they have curtailed it very, very drastically, and that is at the cost of real sector growth. So I personally don't buy this 7% growth argument, because all leading indicators are showing a slowdown. So I feel that, exposed actions by rating agencies or auditors, actually, that is not something we should take whatever comfort from, but we should take comfort from the fact that NBFCs curtailed their growth aspirations and focused more on retailization and liability side, which is a very, very desirable development.
Okay, so we're learning, but after the event and with considerable pain. But Hemendra, you talked about, how the large banks have subsidiaries and you are very much against it. And I would agree with you over there, because there is talk now that the RBI is now all set to activate an old proposal made by Shyamala Gopinath, former DG, Deputy Governor, that banks should be ring-fenced from other group subsidiaries by adopting the holding company model, so that activities of non-banking subsidiaries do not impact the bank balance sheet. In the present crisis, we've seen mutual funds also get into trouble thanks to their excessive exposure to NBFCs. Will a holding company model reduce contagion and make it easier for the regulator to take a tough stand? Hemendra.
Yeah, I think that would be a better option, because ultimately we don't want other risks, non-banking risks, to fall on the bank depositor. But unfortunately, the way the pyramid structure is based on ownership, in many cases, like even Kotak Mahindra Bank, the bank is the holding company for all these entities. But I think essentially one has to look at the entire economic model that we have adopted, which has got us into this crisis. This whole space infrastructure should never have been given to the private sector. This is something which the government should have done. And it's precisely because you hand it over to the private sector that all these problems have now arisen, because then you need a private infra to, to finance it, which ends up being financed by government banks. So in the end, the state in some ways financing private enterprise. So therefore, in my view, the entire economic model that we have adopted needs to be seriously re-examined.
Seriously, that is true. But I'm afraid we ran out of time completely, so it's time for me to draw this discussion to a close. Obviously, the regulatory regime that we had when NBFC is only about 10% of the banking sector must be vastly different now when they account for about 37% of the aggregate loans and advances of banks. How can we have a framework that allows NBFCs to grow, as they do serve a very important segment that the banks don't do, even as we control the risks that banks face when they fund NBFCs? How do we ensure greater cooperation, greater coordination with SEBI and RBI? Many questions to be asked and not very easy answers. But thank you so much, Rupa, David, as well as Hemendra, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.